Okay, so good morning, everyone. Thanks, Governor Hernández de Cos, for your introductory remarks. It is time to go for the first session of the program, in which we will tackle the complex question of the nature of global imbalances, their past, present, and future. And in order to deal with these issues, we are probably one of the best possible companies, surrounded by 4 world-leading economies with a huge amount of expertise on global issues and international economy and global finance that come actually from a rather diverse set of institutions, which I'm sure is going to enrich the discussion and the perspectives provided herein. So close to my left is Christine Forbes from the MIT Sloan School of Management. To her left is Brad Setzer, Senior Fellow for International Economics at the Council on Foreign Relations. Jumping into the European front, we are very happy to count on Alain Gablet, Head of International Policy Analysis at the Swiss National Bank, and to the extreme left, or right, if you prefer, is Livio Straka, Deputy Director General of International and European Relations at the European Central Bank. So we are very honored and grateful to have you here. I'm sure we will enjoy a very nice discussion on this extremely complex but relevant issue. We have, in order to organize the presentations and the discussion, we have divided the first round of interventions into 2 main blocks. In the first one, they will deal with the nature of global imbalances, whether they are of commercial or financial nature, and also on the determinants of these global imbalances. And some of you will deal with the role of demographics, the development of the financial sector. I hope some of you will jump into the delicate issue of the role being played by monetary policies these days into this question. And this first block of questions will be addressed by Christine, and then Alain will also reflect on this. And later on, we will jump into the, let's say, the geographical dimension of global imbalances. That is, on the changing nature and role of the main players behind this phenomenon. And Brad will elaborate precisely on the shifting nature of the geographical composition of global imbalances. And finally, Livio will provide his reflections about the role of the euro area in this global picture. So, without further delay, Christine, the floor is yours.
Thank you. I believe I have some slides. Is there a clicker?
Oh, yeah.
Actually, could I speak from up there, or would you rather have me sit here? Does it matter?
Can we? You can, as you wish. You can use it from here. You can.
Okay.
Use that.
I'm going to stand up here. Okay. It's first thing in the morning. Wake everyone up, at least the Americans in the room. Okay, it's a pleasure to be here to start off the discussion on global imbalances. This is a topic we've probably all been at many conferences for many, many years. I was thinking as I sat here next to Brad Setzer, I first met Brad about 18 years ago when we were both working at the U.S. Treasury Department, and one of the key topics we worked on 18 years ago was global imbalances. Luckily, the debate has moved forward quite a bit since then, not only in substance, but just who's having the debate. When we were working on it 18 years ago, it was for G7 meetings, which made talking about global imbalances a bit difficult. So at least now we're moving forward. We're talking about it in the G20, in the broader multilateral context. And again, the substance has improved quite a bit. So what I'm going to do for my comments is talk about some of the different angles of the debate, in particular some of the newer angles of this debate that we have added to this discussion over the last 18 years. And then I'm going to focus more on the financial aspects of global imbalances, which I think have become critically important. And then end by talking about how I'd like to see this discussion pushed even one level further, thinking more about the interaction of the financial components of imbalances with vulnerabilities and risks going forward. And that's an aspect that I don't think we've pushed forward yet enough. But let me start by just laying the framework, since I'm the first person talking on this panel, so to set the stage for the rest of the panel. Maybe?
Is it on?
Are you going to make me move? Oh, how about turn it on? There we go. Okay. So first, global imbalances. When we talk about global imbalances, we usually have a picture like this in our head. This is the latest update from the IMF. Surpluses, global current account surpluses at the top, deficits at the bottom. Technically, they should add up. We all know the data is not great. They don't add up. You have this black line, which is the trade with Mars, that shows how problematic our data is. But for the purposes of today, even though there's been a lot of talk recently about shadow FDI and some of the problems measuring global imbalances, I'm at least going to ignore that for now, talk about the data that we have that we do understand, is I think the data does at least give us a rough idea of where the imbalances are, even if it's far from precise. But the key thing from this graph is that global imbalances have shrunk. They've shrunk by somewhere between a third, not quite a half, depending on how you measure it. But so there might be a tendency to say we don't need to worry about imbalances anymore. They are shrinking. They're expected to shrink more going forward. Maybe it's not as big a concern that merits continued discussion after 18 years. I don't think that's quite right, especially as you look at other angles to better understand risks behind imbalances. And even if they have shrunk, they are still very large. So how do we think about global imbalances, and how do we evaluate if they are a problem or a concern? There's lots of different ways of getting at this. One is just to look at the level of imbalances. When they're big, more red flags, more to think about. That's where we were 18 years ago. Luckily, again, the debate has progressed. So we now know we need to do much more than just look at the level of imbalances. We do need to go a layer deeper. One layer deeper, which is a layer which Elaine will do more of, is to think more about what structural imbalances are. What are equilibrium levels of imbalances? There's a lot of reasons why countries that are, say, young, have a younger population, are saving more, should be running current account surpluses, controlling for everything else. There's some reasons why countries that are reserve currencies, issue reserve currencies, could be running small deficits indefinitely. There's shocks that can hit countries, so you can run large current account surpluses or deficits in any given year, and that's not a cause for concern. So this is one area where we have moved forward. We now have some pretty decent models where we can look at a country's fundamentals, its demographics, its potential growth rates, and estimate what are sustainable levels of imbalances. And then you worry more about when a global imbalance differs from that sustainable or excess level. And again, Elaine will walk through at least some of that. I think that exercise is hard. We can go make some progress in terms of looking at demographics, adjusting imbalances for demographics, and some areas where we've got decent data. Adjusting these imbalances, though, for things like productivity growth, potential growth, gets very hard because those numbers are very hard to predict. But at least we're making progress thinking about imbalances that way in terms of what's sustainable, not just a level. Then another angle of global imbalances where we've made substantial progress is thinking about the use of capital flows corresponding to imbalances. So we all know a country running a current account deficit is generally balanced by a financial account surplus, large capital inflows. So now we focus less on the trade side, or not just on the trade side, but also focus on what are those financial flows being used for. If financial inflows are being used for productive investment to boost productivity and growth in a country, that's less a concern than if the capital flows are going to inefficient investment. And that's a focus on global imbalances that got a lot of attention after the global financial crisis, where the US's large deficits corresponded to large financial inflows, largely going into very inefficient mortgage markets and housing markets. That's a big red flag. And that's a very handy way to think about global imbalances. I was just at the Bank of England for several years on their MPC, and we spent quite a bit of time thinking about the UK's current account deficit. Largest of the advanced economies, hitting levels that were raising concerns, 6% of GDP. One point it even looked like about a 7% of GDP current account deficit. And when we did a lot of analysis of the UK current account deficit, we kept coming back to this. It's financed by capital inflows. What's that money being used for? If it's feeding inefficient bubbles or inefficiencies in certain financial markets, it's much more of a concern. And then where the debate really had progressed is at a place like the Bank of England, where you have a strong macroprudential regulator, a strong macroprudential authority at the Bank of England, then you can talk specifically about tools to use, macroprudential tools to address the inefficiencies, bubbles, inefficiencies in financial markets that might correspond to global imbalances. So again, that's an area where I think this debate has moved forward quite a bit, and I believe Brad is going to talk a bit about some of these cross-border capital flows and some of these financial flow aspects. The angle that I'd like to spend more time on is the financial drivers of imbalances, focusing less on the trade side, more on the financial components of imbalances, which at least 18 years ago when we were talking about global imbalances didn't receive as much attention. But more and more, as financial globalization has increased, financial exposures have increased, these financial components of imbalances are becoming increasingly important, and I think should be front and center in any discussion. So I'm going to talk about the financial components of current accounts, and then that's the flows, and then the stocks, the financial components of the stocks of financial imbalances, and how I'd like to see this debate push forward, thinking about these financial components and how they interact with risks in the future. So that's where I'm going. And again, I think this financial side of imbalances is increasingly important as financial globalization has increased. Even though trade flows are not increasing at the rate they used to, financial flows are fallen compared to where they were in 2008, cross-border financial exposures are still very large. This shows net international investment positions, net international financial exposures, shows how they've continued to increase despite slower cross-border capital flows. And this is only a fraction of the gross financial exposures around the world. So what that means is if you get what seem like fairly moderate changes in exchange rates, moderate changes in monetary policy around the world, moderate changes in growth rates around the world and relative returns, it can lead to large changes in international financial exposures. Is these already existing international financial stocks, the changes in relative returns get magnified when multiplied by these larger international stocks. So that's why I think focusing on this financial side is increasingly important. Okay, so to take a step back, think about these broader aspect of imbalances focusing on the financial side. I know it's first thing in the morning, but I have to put I'm going to put a couple actually, but one equation up here just to focus thinking why this financial side matters. And don't worry, it's not a hard equation. Hopefully you remember back from your undergrad days studying international economics, a current account balance is not just about trade. Current account balances can actually be decomposed into three components. A current account balance is a trade balance, primary investment income, which is basically interest earnings, dividends on your past investments, your past purchases of equity and debt, plus secondary investment income, which is small for many countries. European countries, as we'll hear about from Livio, it's bigger. But the secondary investment income can be cross-border intergovernmental transfers and some other cross-border flows. But again, the key thing to remember is current accounts are not just trade. They also incorporate different investment income flows. And while a lot of the discussion on global imbalances, especially sometimes by senior political figures in certain countries, likes to just focus on trade, it is less and less important because of these big gross financial exposures when talking about imbalances. And here's a graph I did a few years ago when I started working on this that really highlights this. So 2013, 2014, I took the countries that had a GDP of at least $100 billion, and then I took the 15 countries with the largest current account deficits and broke down the deficits into these three components. How much of current account deficits is trade in pink? How much is this primary investment income in yellow and secondary investment income in green? And what you see is some countries on the left, Morocco, Turkey, Ukraine. When you talk about current account imbalances, it is largely a trade story. But for most of the others, it's not. It's just as much an investment income story, a capital investment story, not a trade story. Take the United Kingdom, large current account deficit. Only about a third of that reflects trade deficit. About a third of that is a deficit in primary investment income and a third in secondary investment income. Take Peru, Brazil. A majority of their current account deficits this year was investment income, not trade. And that does make you shift how you think about imbalances. Again, it's not just a trade story. It's much more related to investment flows as these cross-border exposures have grown. Back to the UK, which is really an extreme example of this. If you not just look at the level of what's driving current account deficits, what's driving its changes, most of the changes in the UK current account deficits, this big red flag country, have been driven by changes in investment income, not trade. And here's a graph that makes that point. Maybe? Come on. Nope. Back up. It's too early for the electronics today, too. We back up. Oh, my. Keep going. It's not that exciting a graph, but yes, thank you. Here we go. It's a pretty striking graph. Okay.
UK is always a tricky issue these days. You know?
So what this graph shows is this is the correlation of the UK current account deficit, again, big current account deficit, especially for an advanced economy, and the two main components, net trade in blue and the primary investment income line in red. And what it shows is from 1989 to about 2004, this blue line up there shows that basically all the movements in the UK current account balance were because of trade, changes in trade flows. And that's sort of how we've traditionally thought about current account deficits. But then as you see over since about 2004, now almost 100% of changes in the UK current account balance are due to changes in investment income flows, nothing to do with trade. And that's a pretty striking when thinking about imbalances. More and more countries are like this, where the changes are driven by changes in investment income, and therefore changes in exchange rates, monetary policy, and returns in different countries, not trade policy and trade flows. And you can go levels further. I'm not going to do much on this, but you can then break down what's happening on these investment income lines to better understand what's driving these changes in imbalances. You can break down changes, again, for the UK into how much of that's your initial exposure to different investments cross-border, how much is because of differences in relative returns in what the UK people return from investing abroad relative to what foreigners earn investing in the UK, how much is because of the different compositions of investments. UK investors tend to invest more in equity that has in some periods earned a higher return versus debt, et cetera. But this highlights again how important this is to thinking about imbalances. So the UK went from trade that was roughly balanced to a huge current account deficit, about 6% of GDP. This shows the change in the investment income line that drove a lot of that. Investment income went from a surplus of 2% of GDP to a deficit of about 2% of GDP. 4% of GDP change in a current account balance just from this investment line. And where did it come from? In the 2000s, a lot of UK had positive returns on its international investment, largely because of this composition effect. It invested more in equities relative to its liabilities, and equities were doing well during that period, so it earned more. But then also the UK earned a higher return even after controlling for its share in equity, share in debt, et cetera. And that reversed quite strikingly around 2012 to 2015, where UK investments abroad started to earn quite a bit less than people who invest in the UK. And a lot of that was weak performance of investments in the euro area, as the euro went through a prolonged struggle, as Livia will undoubtedly talk about. So that's just an example of the type of decomposition we can now do to really understand global imbalances, focusing on the financial side much more to understand what's going on, what's driving changes, and then think about how much we should be concerned. So that's the flow side. But even more important than the current account imbalance in any given year, which is really the investment flow and the trade flow, is the stocks. And that's where the numbers have grown quite a bit, and the changes can be even more striking, especially if the main reason why you can't worry about imbalances is because of large external stocks, which can lead to large imbalances and especially solvency concerns for some countries that have large external debt. So that's where I want to shift next. One more equation, if you want to think about external solvency, risks related to imbalances on external solvency. Changes in a country's net international investment position, its total borrowing or net borrowing and lending from abroad, can be broken into, or changes in that result from changes in your trade balance and your investment income flows, what we just talked about, the current account, and also changes in the valuation of your past investments and past debt, past liabilities. And more, it's these changes in these valuations that can be bigger and bigger and drive some very large changes in a country's overall net investment position, which then determines what risks are related to imbalances. So let me show you a few examples of how these valuation changes can vary, and how for some countries it means global imbalances are much less of an issue than you might think if you just added up past trade deficits and current account deficits. Well, some countries, they can actually not be in as great shape, even though it looks like they haven't run imbalances or large imbalances in the past. Let me start with UK again. So I'm going to show you a couple of these graphs, and here's how you look at them. If you just or accumulated, say, a country's trade balance over time, you'd get this dashed blue line. The UK would have a net liability position to the rest of the world of about 35% of GDP. If you add on investment income flows, so you look at the aggregate current account deficit summed over time, they'd have a net liability of about 40% of GDP. That's a pretty big liability. That's where if you're running a large current account deficit and you're already starting with that sort of net borrowing position, that's when you do start to worry about countries of having large imbalances that could present a solvency risk in the future. Investors start to worry, pull money out, and you can end up in a crisis type scenario. So that would be a red flag. But over time, to get a country's net international investment position, its net borrowing, you not only need to add up the past trade deficits and current account deficits, which gets you to the blue, where you start to worry, but you also need to account for valuation changes, which is the red. And that's where the UK has benefited. Some of it, as during, for example, the financial crisis, sterling depreciated, then the value of its overseas investments increased relative to UK GDP, and that wiped out a big chunk of the past borrowing. So the UK's net borrowing was, at least in 2015 when I ended this, about 30% of GDP. Still not great, but not as big a concern as 40% of GDP. So that just shows how these movements in exchange rates can really affect your net borrowing positions pretty quickly. Now I'm going to show you some countries that hasn't worked out so well. Sweden. I might just stand down here. Thank you. Nope. No. Okay, I'll start talking about Sweden, and then I'll get to Spain. So Sweden is a country where it works in the opposite way. If you looked at Sweden's trade balances over time and added them up, or looked at current account balances over time, it looks like a country that you shouldn't even be in any discussion of global imbalances. It's run pretty, next one? Yes, there we go. So if you added up Sweden's current account balances and trade imbalances at the top, it should have a huge surplus, a big positive net international investment position. This should almost maybe be a country on a watch list in the other direction, where it is in such a solid asset position, you say it's accumulated too many assets. But in fact, Sweden's net international position is the black line, close to zero. So it's like it's almost lost 80% of GDP of net international savings. I don't know if anyone from Sweden is in the room, but I'd find that quite depressing. The reason is because of, partly, there's been net investment income balance was negative for a period, although not so bad now, but the big loss has been from valuation changes. The Swedish krona has appreciated, and a lot of Sweden's asset holdings are in the euro area, which have lost value. That's wiped out a lot of the past savings by Sweden, and it's acted as a natural adjustment mechanism in a sense. As Sweden's done relatively better, its currency has strengthened, it's lost a lot of this net international investment, which has basically shifted abroad to other regions that haven't done as well. One more example, since we're in Spain. Spain's a little different because it is part of the euro area. It doesn't have the flexible exchange rate. But Spain's another country where if you added up just the sum of its past trade deficits to the dotted blue line, its net borrowing isn't so bad, at least as of 2015, minus 30% of GDP. So not great, but not terrible. But then if you added up its past current account balances, you're looking at a more worrisome negative 60% of GDP net.
What is the final point in the time window, Christine?
Oh,
here?
it's about 2015, 2016. So then if you, so Spain has lost over time. Its investment income balance has been negative, so that's added to the trade deficit to get this borrowing position. But there were Spain's also had some losses in valuations, exchange rate movements in particular, and then also the value of its past investments. I'm not sure if Livia will talk more about this, but that's led to, adding it all up, a larger negative NIP, which should raise some concerns. That's a big net international borrowing position, big negative. But it's not just caused by trade again. It's about more than trade that has led to that much bigger deterioration. So I can keep showing you those graphs. I think it is interesting to break this down by country, who's benefited, who's lost from these investment income flows, valuation changes, exchange rate movements. It can really shift your thinking about how global imbalances create risks in some countries or others. But one more graph on this. So what's the sort of average? I've showed you some very different examples. Some countries seem to benefit from these investment income flows. Some are hurt. Some it makes them look much more vulnerable than others. What's driving the big movers over time? This shows over a period from 1980 to 2014 what's causing shifts in international investment positions. Trade's a big factor behind these shifts, but changes in valuation effects, especially exchange rate movements, are now driving driving big components of shifts in your overall borrowing positions. And that role has increased over the last decade. So look, the axes on this is quite a bit bigger. So now in all countries, about 60% of your changes in your net borrowing positions are driven by these valuation changes. So when you talk about global imbalances and risks from imbalances in assets and liabilities, more and more you really need to think about these financial flows, exchange rate movements, how those affects the valuations of your borrowing and assets abroad. So that was a lot. Let me tie it all together. So when you talk about imbalances, I think the discussion is helpful in how it has shifted. So it's less about just trade. It's not just a trade story by any stretch anymore. It's more and more about the financial components. And these financial components, these movements, you can break down into what's being driven by exchange rate movements, changes in relative returns, changes in how countries have invested, what currencies they've invested on, their exposures to equity versus debt, and their initial positions. So the last thing I want to talk about is where I'd like to see this debate pushed a bit more forward, to take this sort of analysis, financial exposures, breaking it down into assets and liabilities in the financial characteristics of that, and thinking about how that interacts with vulnerabilities in the world going forward. So more specifically, we can now take these breakdowns of countries' international financial exposures, break it into currency exposures, the composition between debt and equity, how exchange rate movements affect that, and then think about how heightened risk will affect those different components. If risk goes up in that country or in the world as a whole, what will happen to the exchange rates? What will happen to your relative returns? And will that make your imbalance suddenly look a lot worse, or potentially shrink, so you don't need to worry about it as much when risk increases and when there's some sort of negative shock? And when you go through that exercise, I obviously won't go through much more, I'm going to wrap up, but you can suddenly see that current account imbalances sometimes aren't as big a concern as the absolute numbers suggest. Sometimes current account deficits and imbalances can actually absorb shocks and help shift risks from one country to other countries automatically. That's the benign case. But there's other scenarios where a moderate current account deficit or moderate imbalance that doesn't look so bad can suddenly become much worse because of the way it was funded in these financial exposures. And I'll give you one concrete example to make that point. Back to a favorite example, the UK. The UK after Brexit. So in 2015, if you did a study of global imbalances, the UK would probably pop up as a country that should be on your radar. Current account deficit nearing 7% of GDP based on the data we had at the time. Largest current account deficit of any advanced economy. And there was some discussion, for example, by the governor of the Bank of England, of how the UK was so reliant on the kindness of strangers to fund that current account deficit. And a lot of it was in your sort of hot money, your riskier money. Should you be concerned? Then on top of that, the UK decided to hold a vote on membership in the European Union, the famous Brexit vote. And in June of 2016, there was the surprising outcome that the UK voted to leave the European Union. Not surprisingly, that led to a big spike in risk in the UK, the riskiness of investing in the UK. Sterling depreciated within a few quarters by roughly 15%. The Bank of England announced a large monetary policy package, easing monetary policy that lowered the relative return of investing in UK relative to other countries. The value of UK foreign assets, though, went up relative to UK GDP, largely because of the fall in sterling. Trade wasn't impacted that much. There was some hope that big depreciation like that would lead to a boost in exports or net exports. Didn't actually have much effect on trade, largely because exporters that would normally benefit from the depreciation didn't expand because of the uncertainty about what trade arrangements would look like in the future. So basically, you've got some big adjustments on the current account deficit, on global imbalances, on international assets and liabilities, the NIP position, just from the financial moves, not because of trade. So I took this framework I just walked through with you here to try to calculate what the effect would be. So in real time, should you start to worry more about the UK current account deficit after this Brexit vote, this big increase in UK risk aversion, or should you worry less? And based on this framework I just showed you, what came out of that was an interesting conclusion. You actually didn't need to worry as much because the UK has the structure of its global imbalances in a way that naturally shares risk with the rest of the world. So when you have a big UK shock, it doesn't make the imbalances look worse. It actually makes them look better, largely because UK investment abroad is largely financed in sterling, and you get big exchange rate movements. So here's some calculations we did, again, in real time. We estimated that as Brexit hit 15% depreciation, that the UK current account deficit would, instead of getting worse during this crisis period, assuming no change in relative income and trade, would actually improve. We estimated it would shrink by about 0.7% of GDP. It ended up shrinking by about 1% of GDP, just in terms of better investment income, because of lower relative returns investing in the UK. So UK investments abroad did relatively better. But the big moves were on this international investment position. Some people had worried about the UK being a large international borrower. It started from a net debt of about minus 25 to minus 30% of GDP. That was almost entirely wiped out after the Brexit vote. So the net borrowing position went down by, we estimated it improved by about 25% of GDP. It actually improved by about 20%. But that largely wiped out the UK's net international borrowing. So then, at least for a period there, it went down to almost zero. So the accumulation of all those past imbalances was largely wiped out because of the nature of the shock, sterling depreciation. The way the global imbalances were financed acted as a natural sort of insurance policy for the US, spreading the risk from the UK abroad and spreading some of the costs. So that's a special example, but the key point of going through it is it highlights size of global imbalances in any given year probably isn't so important. It's really more important to look at these financial exposures, how the risk is spread, and then how that reacts when you get these sort of negative events. Sometimes global imbalances can then become suddenly worse. Sometimes they look much better in these risk scenarios. So just the last slide. I think we have made a lot of progress thinking about global imbalances. It's no more just about levels. It's no more just about trade. It's not even just about structural equilibriums, much more about financial components, financial sensitivities, and how these financial components will interact when risk goes up, the periods you would really worry about imbalances. And in some cases, country-specific vulnerabilities around imbalances could be worse during crisis scenarios, high-risk scenarios. Sometimes these imbalances actually can be reduced. Key for all of that, though, is exchange rates. Having a flexible exchange rate is key for those adjustments. And I just showed an example of how global imbalances can be risky, but they also can be risk-sharing. So it is not all negative just having large imbalances. And I'll stop there. Thanks.
Thank you very much, Christine. So,
Thanks.
that's a very global picture of global imbalances, actually. So it's time for Alain, please. Alain?
Yeah, so...
Are you using the slides? Okay.
I'm not sure if the mic is working. Is it working?
Yeah, it is.
Okay, so I think I follow Kirsty's example and move up to the lecture. Since I'm from a central bank, I should add a disclaimer that any views that I express here may not necessarily reflect those of the Swiss National Bank. So under this year's Japanese presidency of the G20, there have been a lot of discussions about the implications of demographic change for a whole range of macroeconomic indicators. And one of those macroeconomic indicators is global imbalances. The basic idea here is that countries that are at different stages of the demographic transition will also differ in terms of how much they will want to save for retirement. And so what I'll try to do in my remarks is I'll try to quantify the impact of demographic change on global imbalances. And to do this, I'll draw an analysis by two colleagues of mine at the Swiss National Bank, Miriam Rinavi and Laurence Wicht. So what they have done basically is they've refined the demographic specification of the IMF, the International Monetary Fund's external balance assessment current account model. So this is an IMF workhorse model. It includes about 50 countries, including all the larger ones. And the IMF uses that model in its annual external sector report, for example, to assess whether countries' current accounts are in line with economic fundamentals. And this model is regularly refined and updated. The latest refinement dates back to last year. And there are two distinctive features of my colleagues' analysis. The first feature is that rather than focus on a few demographic indicators such as the old age dependency ratio, which is what is typically done, they look at the impact of the entire population distribution on the current account, and they also look into the role of pension systems. So I hope here we go. So there are three key findings from their analysis, which I'll go through shortly. The first finding is that, that's the most obvious one, so cross-country differences in the distribution of the population across age groups have a significant impact on current account balances. The second key finding is that pension systems can amplify or dampen the impact of demographics on the current account, depending on the type of pension system. And the third key finding is that future demographic developments should lead to a reversal in demographics-induced global imbalances. So I'll start with the first key finding, which is that differences in countries' age structure affects the current account balances. On this chart, what you see is you see the estimated impact of a 1 percentage point increase in the relative size of a given age group on the current account expressed as a percentage of GDP. So basically these are the estimated parameters of the model, one for each age group. And what you see is that young individuals, so those aged between 5 and 24 years, significantly push down the current account balance, while those, the prime working age individuals, so those aged between 45 and 69, significantly push it up. And the estimated impact for retired individuals is negative, as you can see, but it's not significant. So this is all in line with the life cycle model of savings, which says that individuals borrow when they're young, save during their working years, and then deplete their savings once they reach retirement. And it's also in line with a whole range of micro-level studies which look at the behavior of individual households. And what it implies is that countries which have a large proportion of the population in their prime working age should run, or will tend to run, current account surpluses, while countries with either a very young or very old population will tend to run deficits. So I now move over to the second key finding, which is that a country's pension system also matters. So my colleagues distinguish two types of pension systems, pay-as-you-go systems and fully funded systems. They only consider mandatory schemes. And to just give you a brief definition of those two systems, so under pay-as-you-go systems, the government taxes, so this is the pure version of that system, the government would tax the current working population to pay the pensions of current retirees. And fully funded systems, in contrast, use contributions from current workers to accumulate assets to pay future benefits. So in other words, pay-as-you-go systems redistribute assets, while fully funded systems accumulate assets over time. So what my colleagues find is that pay-as-you-go systems dampen the impact of demographics on the current account, while fully funded systems amplify this impact. And the way one could interpret this, or the way we interpret this, is that pay-as-you-go systems may discourage primary age worker for saving, because basically it's a promise by the government that you're going to get a pension later on, so you don't have to save as much. And fully funded systems, on contrast, under the fully funded system, primary age workers may save more than they otherwise would, so it's like a compulsory savings rate. There is a caveat that I should probably make, which is that it's not always easy to classify pension systems into pay-as-you-go and fully funded, because those systems differ in many dimensions across countries. And the analysis here is based on a classification by Bloom and others, which dates back to 2007, which my colleagues have refined and extended. So now I come finally to the third key finding of the analysis, which is that future demographic development should lead to a reversal in demographics-induced global imbalances. So what you see here is the current population distribution for emerging market economies in blue and advanced economies in red across age groups. So many emerging economies are in an early stage of the demographic transition. In that stage, the share of workers is still increasing. And so in those countries, what you see here is that a large part of the population is below 40 years old, so below the prime working age. So in contrast, most advanced economies, so the blue line, are in a late stage of the demographic transition. So during that stage, the share of workers has already started to decrease. And what you see on the graph is that the large part of the population for advanced economies is between 40 and 65 years old, so exactly around the prime working age. So what that means is simply that demographics-induced savings should be substantially stronger in advanced economies than in emerging economies. But of course, whoops. Yeah, now it's over, I guess. I think I have the same problem as Kirsten. So maybe I start. So of course, emerging economies will also age. So what we'll see in a minute is the UN projections for emerging market economies and advanced economies in 2050. Here you go. So the dashed lines are the projections for 2050. And by then, the age distribution for emerging market economies, so that's the dashed blue line, should roughly resemble the current age distribution of advanced economies, so the red line. So emerging economies will have caught up with the situation of advanced economies now. And so at that point, demographics-induced current account imbalances should have basically reversed. So emerging economies should be saving for retirement, while advanced economies, who will be even older, so that's the dashed red line, should be drawing on their accumulated surpluses to finance old age pensions, so running deficits. So based on those demographic projections from the UN, we can use the estimated model to quantify the future impact of demographics on the current account. We just hold everything else except demographics constant. And so what you see here is the impact for early and late stage countries. So the grouping we use here is from a Swiss non-paper for the G20 Framework Working Group. So the early stage countries, the blue line, that's the 5 youngest countries in the G20. And the late stage countries, that's the red line, are the oldest 5 G20 countries, including invited countries. That's why you have Switzerland and Spain in there. And so basically you see the impact of demographics and pensions on the current account across time based on the model estimates. So first I'd like to focus on the left side, and I should add that so all of the countries in the early stage are emerging economies and all of the countries in the late stage are advanced economies. So if we first focus on the left side of the graph, so that's the part in white, this shows the estimated impact of demographics on the current account balance from the turn of the century until now. So what we see is that for the early stage countries, so the blue line, the impact of demographics has been negative because there the share of prime age workers is still quite low, so low savings. And in contrast for the late stage countries, so that's the red line, the impact has been positive, but it's already peaked, so the peak impact is already passed. And this is consistent with those countries' large but already declining share of prime-age workers. And if we now focus on the right part, that's the gray part, maybe it's blue or gray, I'm not sure, that shows the projected future impact of demographics. And what you see is that advanced and emerging economies are essentially switching positions. So today's early stage countries should start to accumulate old age savings and see their current account pushed up. And today's late stage countries should start to draw on their accumulated old age savings and see their current account pushed downwards. So just a very few short words to conclude. So since aging occurs synchronously across countries, free capital flows can provide an efficient way for aging countries to invest savings abroad. Currently, this mostly concerns advanced economies, but in the future, it should also concern emerging economies. But crucially, how much a country will actually save for retirement depends quite a lot on how a country's pension system is set up. Thank you.
Thank you very much, Alain. So it's time for Brad.
There you go.
No. Is it on? Can we make from the keyboard, Daniel?
That's better.
Muévelo con el teclado. Sorry for this.
There we go. Works. Perfect. So I'm going to introduce a little bit more of a policy component to this discussion. The general view, I think, of the world, at least the view that I would ascribe to most people at the IMF, most people at, say, the Peterson Institute, is that you can divide the world or the imbalances of this world into two. There is a component of the imbalances which have traditionally been the center point of the political debate. Those imbalances, broadly speaking, are those that span the Pacific. China's surplus on one side, the United States deficit on another. And then you could also increasingly look at the imbalances across the Atlantic. The United States deficit on one side, and then in particular Germany's surplus on the other. To overgeneralize, the conventional wisdom, I would say, not the conventional wisdom amongst those in the Trump administration, but the conventional wisdom of the Anglo-Saxon economic world, is that the trans-Pacific component of global imbalances has been much reduced. China's current account surplus has come down. The American president focuses only on the bilateral deficit, broadly speaking, missing China's global adjustment. And one of the old policy causes of imbalance is excessive reserve accumulation across East Asia. Manipulation has also been moderated over time. China certainly is no longer heavily intervening, judging by the data. And intervention in Asia is, broadly speaking, yesterday's problem. What remains a problem in the Peterson Institute worldview is the large, persistent surplus of the Eurozone as a whole. And by the Eurozone, let's kind of think more broadly. Let's include Switzerland, You probably should include Sweden, Denmark, but you can't speak of Europe as a whole because, well, the UK is still part of it, and the UK still has a deficit. But for the euro zone or euro area, really it is a discussion that is a little bit broader. I'm going to challenge one component of that. I'm not going to challenge the component that deals with Europe. I think the conventional interpretation of the persistence of the transatlantic imbalance is right. But I am going to push back against the notion that trans-Pacific imbalances are yesterday's problem, for two reasons. The first is that China is not indicative of patterns throughout Asia. The Asian newly industrialized economies have seen their surpluses go up, not go down over time, and now run substantially bigger surpluses than before the global crisis. But then to be somewhat provocative and perhaps lead into the second panel here today, I worry about the durability of China's external adjustment. Europe. To be provocative, I think there is a reasonably strong argument that the Stability and Growth Pact has locked the euro area into structurally too tight a fiscal policy, one where those countries, if the pact were ever to be seriously enforced, with debt to GDP ratios above 60, are forced to bring those debt to GDP ratios down quickly. And those countries which have relatively low public debt to GDP ratios, such as Germany and the Netherlands, are free to run fiscal surpluses to that add to the structurally tight position if they so want. The rules were, broadly speaking, designed for a world where the main risk was perceived to be those created by large deficits. It wasn't designed for a world which is caught at the zero lower bound, one where tight fiscal policy, in a sense, by one country, certainly a country that has fiscal space, makes it harder for the euro region as a whole to get off the zero lower bound. The result, certainly, of the euro area's fiscal stance and fiscal rules, compared with the political choices made by the United States, has been a large gap, and I would argue as large a gap as there has ever been between the fiscal stances in the one side of the Atlantic, in the United States, and that here. So when an American looks at Europe and looks at the euro area over the past 10 years, they tend to notice that the euro area has failed to generate much demand growth. Demand growth inside the euro area over the last 10 years has averaged a little over a half point of GDP. I don't know that anyone knows what the sustainable growth rate is for the euro area right now, but I think there is a reasonable basis for believing that the euro area's potential pace of growth is faster than half a point of GDP, and thus that the euro area in aggregate over the past 10 years has failed to provide enough demand to drive its economic growth to its potential. The counterpart of this shortfall in demand has been a lot of reliance on net exports. This is the cumulative contribution of net exports to growth broken down by countries. And I think the key point here is that cumulative contribution, which is just a different way of measuring the real surplus, soared during the euro area's most intense crisis, but hasn't come down afterwards. It looks like a permanent shift. And then it's kind of jumped a little bit and fluctuated a little bit more recently. I think that's probably taxi. So this is another way of showing it, that the euro area during the crisis drew very heavily on the rest of the world for demand, didn't give much back, and then got a nice little boost from the Chinese and US stimulus a couple years ago, and without that stimulus is fading back to trend. This is the change in the structural balance of some key parts of the world. I would focus mostly on that of the United States and the euro area. The euro area and the United States both tightened, in my view, prematurely in 11 and 12, but also there's been shifts subsequent to the euro area crisis, where the euro area has not reversed the fiscal tightening that occurred during the crisis. Whereas you can see from the shifts in the structural balance of the United States, the US has made a policy decision to run larger fiscal deficits to support a higher pace of growth. The net effect, and this is unfortunately I didn't put enough color on my slide so that the euro area's fiscal balance looks like a ghost. But which is sort of true, because when you look at the aggregate fiscal position of the euro area, it is basically in balance. But I think what strikes me in this chart is that for most of the past 20 or even 30 years, euro area fiscal policy and US fiscal policy broadly moved in the same direction. And there weren't, at least until the crisis, all that large differences in magnitude. The US, focusing on the dashed red line, which is the line that the IMF uses, did a larger stimulus during the crisis, reversed it, and now has decided to run a wider fiscal deficit than it had in the run-up to the crisis. The euro area has decided to prioritize zero, getting to zero, staying at zero. Broadly speaking, has succeeded at the euro area. And as a result, there is a close to 5 percentage point gap between the fiscal stances of the US and Europe. Straightforward story, one that easily explains the transatlantic imbalance, also one that in principle is very easy to correct. If you ignore politics, tighter fiscal policy in the US, looser fiscal policy in Europe, and you would get the outcome. The euro area's relatively tight fiscal policy, though, does have one clear global implication. This is a graph that also could benefit from more strong colors, that shows the stock of available bonds issued by the best rated euro area countries, those with the most liquidity, relative to euro area, relative to global demand for euro area reserves. Not issuing, if you're the Germans and if you're the Dutch, having the ECB buy means that the stock of bunds and stock of Dutch government bonds in the market is falling. It now only meets about half of global demand for euro area reserves. And if you include the French bonds, the sum of German, Dutch, and French bonds is roughly equal to global demand for euro reserves. Concretely, what does this mean? It means Europe's not using its position as a global reserve currency because of self-imposed constraints, but it also means that funds are effectively being pushed out of Europe through a lack of supply of safe assets. Asia. What does China has adjusted, the imbalances between the US and Asia are over story miss? I think it misses the fact that China is not typical. I think it misses a lot of hidden intervention through sovereign wealth funds in Singapore. In Korea's case, it's not just a funded pension system, it's a funded pension system that's investing half of its assets abroad. And then some regulatory choices that encourage financial outflows from Taiwan. But above all, and I'm glad the IMF's China team is here, it misses the risks that I think continue to be posed by China, where there's a serious question about the durability of an investment rather than a savings-led adjustment. The IMF has reported that China now runs a 12% of GDP augmented fiscal deficit. I'm sure the Chinese will question whether the IMF is accurately capturing China's fiscal position. But I think if you believe that China's 12% of GDP fiscal deficit is unsustainable, then by implication, you believe that China's current account adjustment is also unsustainable, and thus risk remain. Here is a chart showing in dollars the current account surpluses of various Asian economies. China's surplus soared and was the clear driver of the Asian imbalance up to 2008. But much of the adjustment that followed 2008 was a shift from China's surplus to a surplus of Korea, of Singapore, of Taiwan, not a shift in the surplus out of Asia. And in the high-frequency data that has emerged for this year, China's surplus has jumped again. The conventional story also would say that intervention is a story of the past. I think that's to some extent true. The high levels of reserve growth that characterize the pre-crisis world have come down. China clearly sold large quantities of reserves in 2015 and 2016. But at least when I do the disaggregation and when I include proxies for sovereign wealth fund flows and proxies for net lending abroad by policy banks, I find a smaller, but not insignificant amount of officially driven outflows. This is obviously of concern in the US, where the traditional, although not the Trumpian, definition of currency manipulation emphasizes official asset growth. Looking at the very high or quarterly frequency data doesn't suggest that the Asian aggregate current account surplus has come down in a durable way. The quarterly surplus with the increase in China's surplus is back at about 150 billion. That is smaller as a share of Asia's GDP, is a little bit smaller as a share of the GDP of its trading partners. And at some points in time, much of that surplus is going into official asset accumulation. It's just no longer going into official asset accumulation at the central bank. Last couple of points, and I'm kind of playing fast and loose with the data here to make an analytical point. I combined GDP-weighted the savings rates of the main Asian economies, the NIEs, Japan, and China. China's savings rate has come down ever so slightly as a share of its GDP. But China's GDP has grown relative to that of the low savings countries in the region. So in aggregate, East Asia's savings is as high as a share of its own economy as it has ever been, at around 40% of its GDP. The current account deficit that goes along with that high level of savings has been reduced relative to the pre-crisis period by a high level of investment, particularly a high level of investment in China. But if you think that over time, investment in Asia sustainably will likely fall back to 30 to 35% of the GDP, you would question the durability of the current account adjustment so long as the aggregate savings rate in North Asia remains at 40%. Europe's around 30, US is around 20. This is still an exceptionally high savings rate. This just shows this. The Asian savings rate writ large is 2 times that of the United States. Hence, the raw material for a significant reemergence of imbalances in a flow sense is available. And since much of China's adjustment has been driven by investment, you can kind of decompose that and think about what that means in trade terms. And concretely what that means, I think, is that a large deficit in raw materials, since investment is rather raw material intensive, offsets a still large in dollar terms or relative to China's trading partners surplus in manufacturers. If my fears were to come true and the high level of investment in China is ultimately unsustainable, that commodity deficit would fall while the manufacturing surplus would remain. It doesn't take a politically skilled genius, a very stable genius, to figure out that this might cause some political problems in the United States. So what of the US? Our imbalance has come down. It's all come down because of oil. So let's take oil out of the equation. Used to be a big source of global imbalances, it no longer is. The US today, in stock terms, has a net external debt of about 50% of our GDP. It's gone up over time, persistence of current account deficits. We actually haven't gotten cumulative valuation gains over time because the dollar has went down, then went back up. What is on the other side of supporting that external debt? Well, we export about 5% of our GDP in manufacturers, not that much. And then I did some readjustment of the balance of payments, so I put a lot of the income surplus, FDI surplus, together with America's IPR exports, since when you, as the FT and others have pointed out, disaggregate the sources of the US's excess foreign direct investment income, it's kind of all coming from Ireland and a few other places, so it really looks like hidden IP returns. So I took them. And I said, what does that make the US look like? Well, on one hand, look, we do have this additional source of support for the manufacturing trade deficit, something that Trump doesn't talk about. We have a 2% of GDP surplus in intellectual property and offshore investment income. But that surplus is fading a little bit over time, and the manufacturing surplus is trending up. And this graph really failed. But there is, in principle, a rising net external debt position that goes from 15 to 50% of GDP that corresponds with these various measures of the US's non-commodity export base. And my point is simple. Pick any measure you want of the US's non-commodity export base. Our external debt has gone up quite substantially over the past 20 years, while the export base that in theory supports it is broadly speaking unchanged and now falling. I think that should weigh or concern those in the world running surpluses just a bit, because I don't think the US can accommodate any further change in the aggregate surplus of the rest of the world. And as I mentioned earlier, I worry that China's adjustment isn't based on durable changes. Thank you.
Thank you very much, Brad. So, Livio.
Okay, so hope it works. So first of all, thanks a lot to the organizer for inviting me to this great panel. Also, it's great to be here in Madrid, and also in this room, which I like very much, and also flattered by, as I heard, by the fact that we enter to the entrance that is usually reserved for the king. so that's that I find very, very nice. So very nice for on the side of the organizers. So my presentation is mostly about the euro area, and as Christian and others have talked a lot about financial issues, I will not really go much into that. But let me say from the outset that I do agree that financial factors and balance sheets are important. I mean, I'm slightly less convinced than Christian on the fact that these are really crucial in the sense that these are partly unrealized gains and losses. I mean, it reminds me a little bit when people tell me that my apartment in Frankfurt has doubled in value. Of course, my net worth, I mean, properly calculated, is probably gone up, but for me, it doesn't change my consumption or my behavior because this is just an unrealized gain. So only if I sold my house, then I would. So I'm not sure whether this is really, but this is a would deserve a separate discussion. So let me focus now on the euro area current account. So one thing that I wanted to start with is that we all know that correlation is not causation. But I usually find that when there is no correlation, usually there is also no causation. So the two things are different. So I think is a good way before you build a more structural model. You look at structural shocks and things like that. Then you really look if there is any correlation in the data. So as Brad already mentioned, the euro area surplus is a concern. And I agree with that, or not that I agree with that is necessarily a concern for the rest of the world, but certainly something which is unusually should be looked at. So let's have a look at what variables are most correlated empirically with the euro area surplus. So one factor is certainly oil. So you can see in the upper left chart. So the time series of the current account and the oil price are, so the oil price in this case is inverted. So basically if the oil price falls, the euro current account goes up because the euro is an oil importer. And then on the upper right chart, you see a graph of the same current account surplus or current account of the euro area. And two basically net lending variables. So the government net lending and the corporate net lending. And here what is striking is that the largest correlation is really with the corporate net lending. So as firms, non-financial firms save, this has been really associated and correlated with the current account surplus. We don't know exactly why. So this is an area of investigation, not only the ECB, but also the IMF in other places. But certainly there is a strong correlation with these two variables. And then let's, on the bottom, I put two charts which are perhaps most related to the recent discussion on relative monetary policy and exchange rates. Again, we already seen that. So on the bottom left, you see the interest rate differential between the US and the euro area. So the fact that basically interest rates are higher in the US than in Europe. And on the bottom right, you have the relationship with the euro-dollar exchange rate. Okay. So here there is also some correlation, but it's also time varying and not very clear. I would say less clear than for the other variables they showed in the upper charts. And here, basically, I summarize a little bit what the evidence says. So, as you would expect, there is a strong positive correlation between the current account and the oil price with a negative sign. The general government balance, as I mentioned, very high correlation, so 0.8, with the non-financial corporations net lending. Some correlation with the right sign with the US euro area interest rate differential. And then, I mean, for the exchange rate, there's been a lot of discussion recently whether the dollar exchange rate is more important than the real effective or nominal effective exchange rate because of the dominant dollar pricing, work by Gita Gopinath and others. But for the euro specifically, actually the correlation is higher with their effective exchange rate. And why is that? Is because the euro area imports and exports are still predominantly denominated in euro. Because we do have some invoicing in dollars, but the biggest chunk of the price is actually euro. So at least for the euro area, the dominant currency pricing paradigm doesn't really hold completely. So one striking feature of the adjustment in the current account has been its asymmetric nature within the euro area. So you're probably already familiar with this feature, but it's still striking. So you find the so-called euro area core countries in blue and the so-called peripheral countries in yellow. Actually, don't take this word for don't quote me on this because this is a language we don't usually use at ECB. But nevertheless, just to fix ideas, let's divide the groups into core and periphery. And so you will see that basically all the adjustment towards surplus has been done by the peripheral countries, which basically had a deficit around 6% of GDP in 2008, and they now have a surplus of around 2% of GDP. But if you take the surplus countries, these have barely moved since the global financial crisis. So on the one hand, I mean, we tend to sometimes to criticize the IMF when it focuses on individual countries. So we would probably not agree with the discussion that is Germany versus US in terms of adjustment. So we would tend to think that the euro area perspective, at least as far as euro variable is concerned, so if you speak about the euro exchange rate, this should be a channel adjusted for the euro area as a whole and not for Germany. So from that perspective, is useful to take a euro standpoint, but from the point of view of understanding what's happening, certainly Germany and Netherlands are a peculiar case. And the fact that there's been this very asymmetric adjustment is certainly food for thought. There is a long literature going back to Bretton Woods about the asymmetric nature of the current account adjustment. So basically, that only the deficit countries adjust, and the surplus countries are not forced to adjust. So now I want to spend a couple of slides on the FX as a channel of adjustment. So a lot of discussion has been on the role of exchange rates and whether basically movements in exchange rates clear, do not clear global imbalances. So I'll show some evidence, but it's well known that this adjustment channel is weaker than we would like or weaker than we learned on textbooks. And there are basically two potential explanations. Again, I'm focusing mainly on trade. Exchange rates also have a financial component. This financial component is particularly important for countries having large currency mismatches. So either a positive or negative foreign currency position. So this is not the case for the euro area as a whole. So I will not focus on that, but certainly do not forget that there is a financial dimension in exchange rates. But as far as the trade is concerned, basically there are two possible reasons for a weak adjustment channel. So one is that there is a weak link between exchange rate movements and the international trade. And in turn, there are several possible reasons why that is the case. Dominant currency pricing, so dollar pricing, has been emphasized in recent discussion and literature, but this is not the only reason. Global value chains is another reason for breaking a link between exchange rates and terms of trade. It also 3G complementarities, I mean, in a global marketplace for global firms. So multinationals. So all this implies a weak link, may imply a weak link between exchange rate movements and terms of trade. But it can also be a weak link between the terms of trade themselves and the trade balance. So the reason may be low or unstable trade elasticities. So here, I mean, the title of this conference is about technology. So here is also technology plays a key role. So basically making different goods more or less differentiated or more or less substitutable across countries. So this is really eventually more than an economic question, is more a technological question. So just to show a bit some suggesting evidence, so if you basically put on the y-axis the real effective exchange rate in level, and on the x-axis the change in the current account between basically year t and year t plus 3. So basically this is a relationship between exchange rate and future current account developments. Okay. So you would expect this. Regression line to be negative. So if exchange rates play a key role in the adjustment, but what you find is that you find actually a wrong sign. So if anything, a positive relationship. And these data refer to floating currencies. So basically all the G20, with the exception of China, and China until 2005, of course. And so this, you can do this scatter plot in many different ways, but I can tell you that finding a negative, a significant relationship is hard. So you can find it if you play around it long enough, but if you are agnostic about it, you are more likely to find a positive slope. What is also interesting is that it's easier to find a negative slope, which is what you would expect for euro area countries. So actually, the value of the real exchange rate as an adjustment channel seems to be larger within a monetary union than in a set of floating currencies, which in turn may suggest as a possible explanation that is actually kind of exogenous variation in exchange rates due, for example, to UIP shocks that drives a lot of exchange rate volatility, and that volatility is meaningless from the point of view of correcting current account imbalances. So at least this evidence suggests that it's possible that actually the value of exchange rates or real exchange rates is larger in the monetary union, but it's something which needs to be corroborated by further research. So one last evidence I wanted to show is the link between the exchange rates and the terms of trade. So as I said before, there are several reasons to believe that the link between exchange rates and terms of trade may be weak or unstable, and you do find that. But it's also important to note that the link may be different at different time horizons. So, for example, dominant currency pricing tends to reduce a contemporaneous correlation between terms of trade and the euro-dollar exchange rate, but it doesn't reduce the medium-term correlation, because over time, I mean, this is only important as long as prices are sticky. But as over time price become more flexible, then the relation between the exchange rate and terms of trade reestablishes itself. So this correlation can be seen at different horizons, and the sign may be different at different horizons. And to finish off, I wanted just to mention a couple of recent published work by DCB on global imbalances. There's been interesting work recently published in DCB Economic Bulletin on the role that liberalizing the services sector, the services trade, may have on global imbalances. The Bank of England recently published work showing that trade liberalization in the services sector will reduce global imbalances. So this work confirms the Bank of England findings, but it extends its findings to a larger set of countries. And it basically finds that globally, actually, the opposite conclusion holds. So actually, because because surplus countries, so many surplus countries are already liberalized, very liberalized in services. A further global liberalization in services would actually further increase the surplus of surplus countries. So although the Bank of England results are true for the UK specifically, these results don't extend to a larger sample of countries. This is what this article finds. So another interesting recent work by colleagues of mine has looked at GVC participation. So if countries are more involved in global value chains, does this change their current account position? And so what he finds is that indeed it does. So higher GVC participation tends to increase current account surplus, and the reason basically is that you become a better exporter. So you become a more competitive exporter, and this, in general equilibrium leads you to have at least temporarily a higher current account. And the final point I want to mention is the work on the impact of dominant currency pricing. So we have a global model at DCB, which is called ECB Global, so work is ongoing to incorporate a dominant currency paradigm into that model. And basically what recent published work shows is that basically the response of net exports to a dollar appreciation is inversely related to the basically the difference between the dollar invoicing of exports and imports. Okay, so the larger this differential of the dollar invoicing in export and imports, the less the effect of a dollar appreciation on net exports. So this implies that heterogeneity in the invoicing behavior of imports and exports drives a lot of the difference of how current account adjustment reacts to exchange rate changes. So with that, I think I concluded. So thanks for your attention and for being part of this great panel.
Thank you very much to the four speakers for these initial thoughts. We have some minutes for some discussion among you and for some questions from the floor as well. Let me just pose some questions to some of your interventions. I mean, Christine, you emphasize the idea that external stocks rather than flows may be more relevant, especially in the aftermath of the crisis, in which what we see is that global imbalances measured through flows seem to be shrinking, whereas in terms of the stocks, it clearly the situation is apparently worsening. But according to the information you provided us, an important part of the rise in the imbalances measured as stocks owes to the fact that the U.S. net external position has become, I mean, it was always debtor, but has become larger and larger after the crisis. My question is, how worried should we be about this dynamics, given the fact that an important part of the demand for dollar-denominated assets seems to obey to some special characteristics of the U.S. I mean, a few weeks ago, Krishnamurti and his co-author in Jackson Hole, you were there, were making the point that the demand for U.S. dollar assets obeys very much to the so-called convenient yield motive, and this motive, if anything, is getting more important, more intense, and it's likely to remain like that. So, should we be worried about this widening of the imbalances in terms of the stocks, given that what is behind this is perhaps a persistently higher demand for dollar-denominated assets, and this demand is likely to be quite stable over time.
Right. When we should worry about the U.S. debt position seems to be the million-dollar question, because, of course, part of the reason for the accumulation in the U.S. negative NIP position is the safe haven, the demand for dollar assets. That's part of it. Mm-hmm. But part of it is also the huge increase in the U.S. fiscal deficit, which we saw in some of the other graphs. And that's where sort of the laws of nature are not applying right now. As the U.S. fiscal deficit gets bigger and bigger, the U.S. government debt gets bigger and bigger, that doesn't seem to hit phase markets, at least now. And again, partly back to the U.S. dollar being so dominant. So it doesn't look like this is a concern right now, but I think one does need to think about going forward, what are the implications? You know, if at some point there are other currencies that are seen as reserve currencies, which decreases the demand for the dollar, then I think it's worth thinking about some of those channels that I walked through, is then what would that mean for the U.S. NIP position? Could it suddenly look a lot worse or look better? And that's where the U.S. does have the advantage, since at least for now, so much of the debt is denominated in dollars. If you play out some sort of crisis scenario where people don't want to hold dollars anymore, then the dollar would depreciate. But then the U.S. NIP position doesn't necessarily worsen the way it would in an Argentina or a country like that has huge exposure in foreign currency. So that's where, back to these, thinking about the way these imbalances are structured, how the financial positions are structured, does matter quite a bit. The U.S. does have that advantage. So it's going forward, if you want to play out. So your worst case scenario, people don't want to hold dollars anymore, should we worry about the position? The position could actually look better in that scenario because of this natural hedge. But we saw the flip side. It was interesting during the global financial crisis. And the global financial crisis started in the U.S. You might think that would have caused the panic and the concern about financing in the U.S., but instead it caused people to want to hold U.S. safe assets, and the dollar appreciated. So then you actually saw a pretty meaningful deterioration in the U.S. debt position, as in some sense the U.S. risks or assumed was an insurance agent for the rest of the world, where other countries, as other countries' currencies depreciated, the U.S. NIP sort of took some of that adjustment on its balance sheet. So that is, I think, a really important point to bring out. None of us really talk very much about the role of being the reserve currency, and how that does change the risks related to global balances when you are a global currency versus not. And then one last point on that, and that was also, I spent quite a bit of time talking about the UK. The UK is in this special position where it's a major economy, obviously, major financial center, but usually during these sort of risk-on episodes, the sterling is not seen as a reserve currency. Sterling often depreciates, and that is part of what has allowed the UK to benefit from some of these financial positions, these risk-on periods. Sterling depreciates, UK NIP improves. Many other countries do not have that advantage, though.
I had an issue with this improvements in the NIIP following these valuation effects. I mean, my experience with this country in Spain is that valuation effects are not only countercyclical, but sometimes are strongly counterintuitive. I mean, in the case of Spain, when the whole country was suffering a huge economic and financial crisis in the middle of the euro area sovereign crisis between 2010 and 2012, I mean, valuation effects were improving, quote unquote, improving our net foreign asset position for the wrong reasons. And on the contrary, when the economy started to recover, we started to suffer, quote unquote, negative valuation effects because investors simply were were happier to buy Spanish assets. And we have some interesting discussions with the IMF staff on this point. Yeah. So this is a very tricky question. I cannot agree more with you on the need of being very careful when analyzing these valuation effects, looking at what is equity, what are callable liabilities. Yeah. These are more important perhaps in terms of financial stability and so on. Yeah. You sounded a little bit positive with respect to the recent evolution of valuation effects in the UK. I think they are going in the positive direction from a statistical point of view, but clearly as a reflection of a negative underlying economic and financial evolution. But
and that actually, that builds on what Livio said, is that just because your valuation has improved according to IMF statistics, that doesn't necessarily mean people in the country feel better. Until you sell your apartment and get the higher value, you don't actually benefit from it. Yes. And I think that isn't because these valuation effects, during some periods, they can move and make a balance sheet look a lot better, a lot worse. But then they can also move back very quickly, and so you're not going to feel it. But why I think they still are important for certain aspects of the analysis is they do, when the valuation effects mean your NIP position suddenly looks a lot worse, that can then invoke investor concern, runs on currencies, and then you can end up in one of these negative equilibriums. So the levels can matter when they move a lot. So that's when I think whether you sell it or not, or realize the gains or not, they can then provoke panic, provoke concern that then has a whole set of other effects.
Interesting. So, Alain, my question for you is a relatively straightforward one. I mean, you saw us some projections about demographics as a main driver of global imbalances, which I think is out of question. I mean, demographics matter a lot in terms of savings and borrowing decisions at the individual and at the aggregate level. And according to your projections for the coming decades, it seems that due to pure demographic effects, the overall supply of savings in net terms is going to go down because people are getting older and older, both in mature economies like Japan, Germany, Spain, and some others, but also the emerging markets are also entering into this aging path, some of them, including China. So following your life cycle pattern of savings and this saving, one should expect that as the whole population, or a higher fraction of the total population in the world becomes, let's say, above 60, 65, whatever, we should see a persistent decline in total savings. And this, if anything, connecting it with all the discussion about the natural interest rate, would tend to push up the interest rate. No? Have you tried to link your demographic dynamics with this object with R-star, which seems to be so important for many things, including monetary policy? Should we expect any time in the next, say, 10, 12, 20 years a rise in R-star following these demographic trends?
So first of all, about the global supply of savings, as I've shown, we would expect late-stage countries, so advanced economies, to start dissaving. But then you have emerging economies starting to save more. So the question is, what is going to have a bigger impact? So there, we haven't looked at that basically.
But China is unlikely for some reasons is unlikely to save more, right? In the
I mean, they're saving future now to basically build up the economy. I mean, one interpretation would be they're saving now to build up the economy. They have a high need for investment. How long that's going to continue is anyone's guess. China is a bit older than other emerging economies, among others because of the one-child policy.
It's trying to push consumption up as well. So.
But I think one important thing about demographics is that it really brings down our mind to the fact that all those things are temporary. So demographics is a temporary, the demographic transition is a temporary phenomenon. So we're gonna get older, and so advanced economies are gonna start to dissave. But then, if things don't change again, there should be a steady state at some point where savings should balance out. So basically, it looks like one interpretation of current low interest rates is that we're going through a kind of a rough patch where there's as you said, a global glut of savings. This is not going to be like that forever. So it all depends. And then comes in the role of pension systems. So depending what pension system you can have a pension system which is fully pay-as-you-go, and where basically you're just pushing the burden of financing future pensioners to the next generation, to the younger generation. So you can do that, but it just means, basically what it means is you're going to have an intergenerational redistribution of income. And in that case, there's no savings surge, right? So some countries are more on that path, and then some other countries which are saving more are more on the path of actually accumulating the savings to deplete them later on. So it depends what you want. So I think the idea generally is that a lot of countries are probably not saving enough. The problem is that if they were saving enough, then global interest rates would go down even further. So the question is, what is worse? So basically having today's young pay for the demographic transition, or living with very low or even negative real interest rates.
Thank you. Brad, you said that essentially Europe is the problem. I will not question that. I mean, we have many problems in Europe, and I will not deny that. But I missed something in your analysis, which is precisely demographics. I think that introducing demographics in your analysis would probably qualify some of your elements of analysis and perhaps some of the conclusions. And there are two respects in which I think introducing demographics in your picture would matter. I mean, it would matter directly in terms of, I think you would provide a clearer picture if you express the variables that you show us for a relatively large time window in per capita terms. I mean, if you were to rescale the evolution of total demand across the big economic regions, taking into account the demographic evolution, you would get a picture that is not as dramatic as the one you show us, I guess, because demographics in Europe have evolved in a different way than in the US, and especially in the emerging economies that you were showing us. And also, it would matter also in terms of understanding the optimal decisions of agents. I mean, as people in Europe are on average older, I mean, part of this problem of over savings in Europe can be rationalized on account of different demographics. So that's my guess. But I would like to know what you think about this issue.
So what I didn't do is normalize demand growth by population or by working age population. I would be interested in the results. I have a hard time believing that demographics alone explains why in the 10 years before the global crisis, which was also a European crisis, demand growth inside the euro area was on average about 2 percentage points a year. And in the aggregate period, 12 years after the global crisis, demand growth has been about 0.5 point per year. I think because of demographics, it's unlikely Europe can generate 2 percentage points per year in demand growth, but I don't think demographics can explain why European demand hasn't been somewhere between 1 and 1.5 percentage points per year. When you look at demographics more generally, and I think the IMF has done by far the best, I mean, you guys have probably improved on it, but kind of systematic cross-country analysis. And demographics suggest that the euro area should have a small current account surplus. It doesn't suggest that the euro area should have a current account surplus of 3 to 4% of GDP. And one of the more interesting results of the IMF's demographic analysis is that the U.S. is no longer a young country. There are much younger countries. And so as a result, on a demographic basis, the U.S. actually should be in rough balance now because we too are aging. So to me, one of the interesting conclusions of demographic work is ironically that the U.S., which has this very large net debt position, as it ages, probably shouldn't be adding to that net debt position. One little point, because I just kind of like being provocative. I think there's too much made about this natural demand for dollars around the world that propels the U.S. towards this major current account deficit. There is nothing natural about the world from 2000 to 2010, when all of the accumulation of foreign assets in the Asian surplus countries was covering from governments, and all the demand for dollars essentially was the counterpart of that buildup in their foreign assets. You can argue that's natural, but in order to argue that's natural, you have to argue that all of the accumulation of reserves was optimal, which is not something that I would subscribe to. Right now, I don't think you need a special demand for dollars to explain the relative dollar strength or the U.S. current account. Right now, the dollar offers significantly more yield than the euro, than the yen, than the Korean won, than the Taiwan dollar. Ergo, demand for dollars doesn't reflect anything unique necessarily to the United States or the dollar's role in the system. It reflects the fact that the U.S., because of a set of policy choices, fiscal, in the U.S., more loose, fiscal and euro area, much more tight, is the only remaining source of yield in a low-rate world.
Okay. Thank you. So, final question for Livio. I mean, out of the presentation of Brad and out of your presentation as well, it seems clear that the total supply of safe assets by Europe, and in particular by the euro area, is clearly going down. And not only that, but also the distribution of issuers of safe assets is becoming, let's say, more skewed towards Germany and some other smaller core countries, European core countries' economies. So, and this is creating potentially a number of frictions, inefficiencies, and so on and so on. So, on the other hand, however, we see that some of the main tools deployed by the ECB over the last few years in terms of monetary policy, like QE, is probably making this problem of asset scarcity even more acute, because most of the assets purchased by the ECB are precisely very high quality assets. No? To which extent these considerations about the supply, the net supply of safe assets, and the implications in terms of financial stability or even global finance do play a role in the monetary policy analysis of the ECB? Is it time to rethink the set of tools in the monetary policy toolbox by the ECB on base of these reflections about the supply of safe assets?
Of course, it's a slippery question, and of course, whatever I say is not had no relation to the monetary policy decision, which is going to be taken in 2 days, of course. So I think you are right that certainly the combination of shrinking supply of government bonds by AAA countries, as well as the asset purchase program, has created a unique combination of scarcity. Whether this is a monetary policy implementation problem, I would probably say not, because I mean you see that the whole euro area government yield curve has gone down. I mean, does Spain pay positive interest now?
Only beyond 6 years or something like this.
Yeah. So the Spanish yield curve is below zero for most
for
parts
5-6 years. Yeah.
Yeah. So I think the whole, it's not only Germany, but it's a whole yield curve. Even Italy now is barely above zero, which is incredible. So I don't think I don't see a direct monetary policy implementation problem kind of stemming from that. I mean, the broader issue, of course, is the position of safe assets. It's also not clear in my mind. It's a bit related to what Brad was saying. So it's not clear in my mind whether this discussion on the scarcity of dollars is so crucial. I mean, I've seen contrasting analysis. I've seen that the yield of German bonds seems to have even a bigger safety premium than the U.S. So some people say, okay, is there a unique role of the dollar as a dominant currency and the liquidity of the treasury market which makes a difference? But actually, if you just look at the yields, actually the German bond is doing even better. I mean, for example, if you take, if you look at episodes of increased risk or risk aversion, and you look at what bond yields go down the most, so which has more safe asset, actually some countries like Germany, but also Japan, actually outperforms the US. So this discussion on safe assets is more complicated than we think. I don't think that we can really, at least I'm personally not sure that from that perspective the role of the dollar is so unique. But the discussion is very multifaceted and complicated, so I'm just scratching the surface here.
Okay. We are running slightly behind the timetable, but I think we can take a couple of questions from the floor, maybe. Guillermo?
I think that the biggest problem that Europe has in the euro area is that pension systems were, in 1919, were created for the whole of Europe. 1919. Mm-hmm. And the age of retirement at 65 was then established in the whole of Europe. And by then, life expectancy was 33 years. Now, one century later, all continue to have 65, France 62, by the way, and the life expectancy is 83. In Spain is the highest, together with Japan. Japan has the same problem, by the way. So, what is going to happen? What is going to happen? Can you explain to me that? I spoke here at the Senate and the Congress about this issue. And then they decided, we have to do something. And then decided that it would raise to 67 in 2027. We will never get to the 227. And nobody wants to speak about that.
We may pick up another question and then, yes, here, the gentleman over there. Can you identify yourself, please?
My name is Gianpaolo Ruggiero. I'm from the Italian Treasury. And my question, well, actually, rather than a question, is an observation on which I would welcome comments by the panelists, is that I don't quite agree to the narrative that I heard that Europe is the problem, or at least I would qualify that in two ways. First of all, the United States is as much as a problem as Europe, probably more than that. It's the only debtor country which is not, where the asymmetric adjustment does not act. I mean, it can live with its deficit without major problems, at least in the short term. In Europe, I don't know exactly the data, but I think the current account surplus of the euro area is a couple of percentage points. So I understand that you have to talk into aggregates, but I would say that what is a problem is the current account surplus of certain countries in the euro area, not all countries. And the narrative that certain countries, including my own, have improved their current account position I wouldn't say that process is creating a problem. That process is correcting a previous imbalance. We went from a deficit to balance. Some other countries were in surplus and are still in surplus, and there is no adjustment correction mechanism. I would welcome comments on the United States, where I think much deeper analysis deserves to be made, and on the staggered problems of the euro area. And by the way, if my apartment were to rise in value, I would certainly change my behavior immediately, drawing down my financial assets maybe, or decrease precautionary savings.
Thank you. Any reaction from the panelists?
Maybe to
Alain?
the question about pensions in Europe. So this is a problem which is, it's common to many countries which are in an aging process. And the issue is just a demographic dividend. So when you're in the late stage of the demographic transition, you have a lot of people who are in the prime working age with high incomes. So it's no problem to finance generous pension systems with an early retirement age. And then I'm sure you know this, but there's 3 ways to fix the system. You can raise the retirement age, lower the replacement rate, so much pension you get relative to your income, and you can increase savings. And if you don't do any of those 3 things, then it's the younger generation who will pay the bill. I don't have any solution, of course, so I don't know.
Brad?
So is Europe the problem by running too tight a fiscal policy, or is the US a problem for running too loose a fiscal policy? I think in my optimal world, the US would run if not a tighter fiscal policy, a fiscal policy that at least prioritized public investment. So certainly there is blame to go around, and certainly you can address an imbalance by adjustment on either side. The difficulty with all the United States fault narrative is that since the US has loosened its fiscal policy, effectively as a choice to try to seek a faster pace of growth, US interest rates have gone down. So now 10-year US Treasuries are under 1.75, and nominal, in real terms, they're likely negative. The US hasn't faced interest rate pressure or obviously seen crowding out pressure as a result of its own choices. If you look at the euro area, which in aggregate has, let's say, 3% of GDP current account surplus, and in aggregate has a fiscal deficit of about 0.5 point, and in aggregate has negative policy rates, and I don't know what the synthetic 10-year euro area nominal yield is.
Probably around 0.
Probably around 0. So real rates are -1, and has an aggregate failed to generate over the post-crisis period enough demand to support its own growth. I see a region that for its own reasons could benefit from more pro-demand fiscal policies. That doesn't mean every country has the fiscal space, but my aggregate diagnosis is that rather than prioritizing a reduction in the debt to GDP ratio, which is implicit in a fiscal target of 0 deficit, the euro area would benefit from prioritizing a stable debt to GDP ratio, for example. And in your country, yes, there was definitely an imbalance, but when I look at Italy, I see a country whose demand is still 5 percentage points below where it was 10 years ago. And that's not atypical across the euro area periphery. So I think the main difference in view is that it seems to me that the euro area has been structurally weak in creating its own demand. and that rather than correcting an imbalance in a healthy way, it has created an economy as a whole that is deficient on demand without support from the rest of the world.
Christine?
So, a couple comments. So Brad went into a lot of detail in response to should we worry about the U.S. versus Europe, where's the problem? So I won't repeat that or largely agree with Brad. But let me come at it from a different angle. Say you're a U.S. policymaker and I listen to you and I agree, U.S. deficit is the problem. What should we do about it, though? Is then another really difficult question. So if a current account deficit is national savings minus investment, one option is reduce investment more, which I don't think makes a lot of sense in the US. More efficient investment, certainly we can, that makes sense, but reducing investment overall probably doesn't make sense. Then another solution would be to raise savings in the private savings in the U.S. And that I could make an argument, American consumer does not save enough, so that would help. But how you go about that is difficult. You know, there are some ways, but again, not easy. The American consumer likes to spend. The obvious solution is reduce the budget deficit in the U.S. So I would certainly subscribe to that. I do worry about debt sustainability in the U.S., even though we haven't seen the crowding out effects yet, as Brad mentioned. But if the U.S. did reduce its budget deficit, which you could make arguments would make sense, would reduce the current account deficit, get at the issues you're worried about, that is a boost to growth around the world right now. And so there would be some global spillovers that wouldn't necessarily move in the direction a lot of the world would like to see. Another solution could be to have the dollar weaken. If there was some way you could magically weaken the dollar, that would then strengthen the euro, strengthen the yen, strengthen other currencies around the world. Again, that could have some global implications and global spillovers. So while I do agree with your argument, the U.S. current account deficit is an issue, we can't overlook that. There are some long-term concerns, especially if you do the sort of analysis I went through on the financial components. But then when you move to what you do about it, it does get a lot harder. Many of the solutions that would address the U.S. imbalance would have global spillovers that might move in the wrong way for the rest of the world. Unfortunate trade-off. Yeah. One other quick response to the comment on pensions. I won't comment on the European pension system. We have other systems here. But I do agree, the pensions it's a very long-lasting issue. Decisions made last a long time. Just a fun example of this, The Economist had an article several years ago that highlighted that issue for the U.S., where a woman died several years ago who was collecting a pension, a military pension from her husband. Her husband was earning the military pension from the U.S. Civil War, and it was still being paid out not that long ago. Now, for those of you who are not American, this U.S. Civil War is over a century ago, and it's was still on the books for pensions. That's a reminder of just how long-lasting pension commitments can be. Now, if you're wondering how that math worked, by the way, the accounts went through the example of there was a young boy who signed up for the U.S. Civil War when the younger end, I'm not sure if it was legal or not, younger person in the U.S. Civil War, fought in the Civil War, went on, lived a life, got married late in life to a very young woman, Gertrude, who then lived a long time, and that's why the commitments, lasted so long. Not an average situation, but it does get back to your very important point. These pension commitments are long-term issues that we can't forget about.
Good. You mentioned four alternatives to reduce the deficit of the U.S. and then the external debtor position. Yet President Trump tried a different one, a fifth one, out of this different from these four options. But I wish you were in his position to have taken one of these options.
Just one comment on the pension issue. So, Christine mentioned long-lasting effects and so on. I think, at least in terms of excesses of the past, I think the pension issue is being dealt with. So there have been many pension reforms in Europe. I always recall that my grandmother actually spent 44 years in retirement. She was a teacher, and she retired at 55, I think, and she lived up to 99. So she spent much more time in retirement than at work. I think these excesses now tend to not to happen anymore. So there have been pension reforms. So in my home country, there have been quite a couple of quite significant pension reform. But apart from this, I think why I agree with you that is a very important issue. I don't see a mechanic link with the discussion we had on imbalances, because if anything, a pension reform I would guess you should push a country into surplus more than deficit. So we always argue that, I guess that, for China, we have been argued that one reason of the surplus is uncertainty about retirement and the lack of a well-developed pension system. So I guess reforming or creating uncertainty about pensions would, if anything, lead people to save more and therefore to a country to go into a surplus. So the link with the imbalance is not so clear, I think. But in general, that the pensions are very important. We should really reform them, and I would agree fully.
Thank you. So I think it is time for thank you the four speakers and time for a coffee. Thank you.
Thank you.